Hi everybody, Mapletree Pan Asia Commercial Trust have announced their first half FY2223 result. And this is the first time they announced the result after the merger between Mapletree Commercial Trust and Mapletree North Asia Commercial Trust. We'll look at the numbers and also we'll look at is there any growth potential for this new merger entity going forward at this current market environment. This is the headline news. I think everyone will have seen it. MPACT have said that they have 44.9 year-on-year growth in both their revenue and net property income. The number look big, but because that is due to the merger. So I want to go and drill in to look at more detail in this number. Before I go to the numbers, let's look at some background of MPACT. MPACT currently is one of the 10 largest REITs in Asia, and in fact is currently ranked number 5 in terms of their AUM. Among all the 40 REITs and business trusts listed in Singapore, MPACT in fact contribute close to 10% of the total market cap. So how big is this? 9.4% market cap contributions to the REITs and business trust sector. You look at the hospitality sector, where the market cap of all the hospitality REITs add together is only 8%. And the market cap of all the office REITs add together is only 7%. When compared to all the retail REITs add together is only 9%. This shows that actually how big MPACT is in terms of size. And the REITs currently have 18 properties, where 5 of them are actually in Singapore, 1 in Hong Kong, 1 in Beijing, 1 in Shanghai, 1 in Korea, and there are 9 properties in Greater Tokyo. This is the map allocation of where are all those properties located. Although they have total 18 properties, but the weightage of the property AUM is not evenly distributed. Where we can see that VivoCity and the Mapletree Business City, which is the form a core asset for these REITs, or we call the anchor asset for these REITs, which contribute about 41% of the AUM for the REITs. Compared with Japan, we have 9 properties. Actually, we have 50% of the properties of the REITs. We only contribute 10% of the AUM. Another key thing to know is Festival Walk in Hong Kong form about 1/4 of the AUM for the REITs. As for the sub-asset class, the retail, office, and business are pretty well spread out, where none of them have more than 50% in AUM. Let's look at the numbers. Everything is growing in double digit when compared to first half FY2122. That's 1 year ago. And the revenue has grown by 44%, but the cost also went up by double digit, where the property operating expense also went up by 44%. The finance cost also went up by 66%. Okay, dividend distribution per unit also went up by 12.5%. Do take note that this is because of the merger. So when they merge, they become bigger, and which is why you can see a double digit growth in everything, including revenue, including cost, and including the dividend they're able to pay out, because it is a 2 REITs combination. However, the thing on the merger just take effect in July this year. When MPACT going to make their full year financial report 6 months later, I will expect all this to have another double digit growth again, because the full 6-month contribution from the former Mapletree North Asia Commercial Trust have not been factored in yet. Similarly, from this breakdown, you can see that the contribution to the gross revenue by country, where Singapore take up 76%, by contribution to MPI, where Singapore take up by 77%. Why is it so high? Because the other property contribution is only counted from 21st of July to 30th of September, which is slightly more than 1.5 months, while this is a full 6-month report. So we will actually have a better picture on how does the merger contribution as a whole when they report their second half result 6 months later. From this data, I want to point out to your attention on this is Mapletree Business City and the VivoCity, actually their revenue and even their MPI have continued to grow, which is a good thing. The other 3 properties in Singapore, their revenue have dropped and their MPI also have dropped. But however, the contribution of the other 3 properties to the total asset is on the low side. Their financial position from here, it look very healthy, but my focus will be on their net asset value. Are they increasing over time? And in fact, they have increased their NAV from $1.04 to $1.81 after the merger. So it is a year accretive, NAV accretive merger. Let's look at the financial indicator. After the merger, the gearing have went up from 33.8% to 40.1%, although it is still 10% off from the 50% requirement by MAS. But however, with this high average leverage ratio or high gearing ratios, if the REITs were to going to do any big acquisitions, there may be a possibility of some form of equity fundraising. If not, the gearing will go too high. Or alternatively, they may need to divest of some of the property to bring down the gearing. Then from there, they can move on to buy some more properties. So this is one thing investors need to take note of. And the average interest cover ratio actually have dropped from 4.9 to 4.4. It is still within a healthy range. MAS requirement is minimum 2.5 times. The average cost in debt actually have went down from 2.53 to 2.44, which is good during an interest rate rising environment. However, do take note that on the percentage of fixed rate actually have dropped to 72.5% from 78.6%. Although it is still on a high level of above 70%, but we are in the interest rate rising environment now, where means that the balance 27% of the rate are still on floating rate will definitely be affected. Means that their interest payment will be more, will indirectly have a negative impact to their income. And next, we want to look at refinancing risk. Are they going to refinance at a higher interest rate environment? For FY2223, there is another 8% of their debt that need to refinance. FY2324, which is started from March next year, they got another 13% of the debt where will need to refinance. As we all know that the interest rate will remain high for the next 6 to 9 months. So it means that they have about close to 20% of their debt they need to refinance, presumably will be at a higher interest rate. This may have some negative impact to their bottom line, which is indirectly the distribution income that we as an investor will be able to take on. And let's look at the currency, where most of the debt are in Sing dollar and also another 30% is in Hong Kong dollars. And we know that these two currencies are facing the headwind of interest rate rising environment compared to Japan yen, which is about 17%. And we know that Japan interest rate have against the type of rising interest rate have still try to maintain very, very low interest rate. So our main focus will be on the Hong Kong dollar interest rate direction and also the Sing dollar interest rate direction, which definitely is on the upside, where the US continue to increase the interest rate. Besides looking at interest rate, we also want to look at their forex. US dollar have been strengthening and Sing dollar also remains strong against the regional currency. This will also have a negative impact to the dividend we're going to collect. Let's look at interest rate first, where 27% of them are actually on a floating rate. Of this 27%, actually 14% and 11%, or on the majority of the floating rate are in Sing dollar and Hong Kong dollar. We will definitely have some challenge to the risk, as we know that these two currencies, the interest rate have been increasing in line with the US interest rate. Next, look at the forex side, where they have about 12% of their currency that's left unhedged. To me, that is considered a pretty low level, less than 20%, but it will still have some form of impact to them, especially when Sing dollar continue to strengthen. So one thing to counter the interest rate and the forex side is occupancy. If they're able to maintain high occupancy or able to increase their occupancy over time, this will indirectly have some cushioning effect to the rising interest rate and forex. And thus, let's look at the occupancy side. Overall, the occupancy rate actually have a slight drop from 97.2 to 96.9. In general, the portfolio occupancy is pretty healthy. As long as above 95% is considered pretty good, especially at this current market juncture. I just want to point to attention of this. There are two China property where there are the property in Shanghai and Beijing, where we can see that the occupancy rate have been dropping from 97 to 95.1 to 92.5. So the occupancy rate of their two China properties have been dropping constantly. One of the key reasons is because of China zero COVID policy. However, their occupancy rate for the China property is still way above the industrial average of China office building occupancy rate. So we still need to give credit to the risk manager on that, where despite facing a challenging environment, they are still able to maintain above 90% for the China property, where it's much better than among their peer in China. Another concern is there are 3 Singapore properties where the occupancy rate actually is not the ideal of above 95%, is about 93.9. The consolidation is that the contribution for these three SG property to the AM is only around 11%, which is not the main contributor to the REITs. Another data we want to look at to counter the interest rate and the strengthening Sing dollar is their rental reversion. Are they able to charge higher rent to their tenant when it comes to renewal? In general, overall, their portfolio rental reversion is positive by 1.1%. However, as expected, Festival Walk, the rental reversion is down by double-digit 11.5% due to the current zero-COVID policy implemented by China side. But based on my understanding, that I think the worst should be over for Festival Walk. What we see that we should be able to see improvement of Festival Walk, where if China were to slowly relax their policy and allow people to travel to China, travel to Hong Kong. For second half result, we should expect even better performance from Festival Walk. And then this expiry profile is still for FY2223 is only left about 3.7% for retail, 5.4% for office is considered quite low. So our focus will be on FY2324, where they got 13.5% for retail, 14.4% for business park, and we will see how is the rental reversion for this next year. The top 10 tenants contribute about 22.6%, is less than 1/4 of the REITs portfolio. It's definitely not the high side, but of course, as an investor, I prefer the top 10 tenants, the contribution to be as little as possible, so that to prevent any big disruptions. Just like Mapletree Business City have all the work, have very high occupancy rate, 100%, and now Unilever have decided not to renew with them, and this actually caused a drop of around 4% in the occupancy rate for Mapletree Business City. Let's look at the performance for this street year to date. This street year to date have down about 18.97%. Actually, this street was not positive since day 1 to today. This is a 0% point where at start of the year, they start to drop and they have never go back to that. So for those that invest in these REITs, anytime in this year and hold until now, you don't make any positive return. This is the NAV line for this REIT, which is $1.80. So currently, the REITs are trading more than 10% discount from the NAV. Do take note that Mapletree Commercial Trust before the merger was constantly trading at a premium, easily more than 10% at the premium. Okay. However, Mapletree North Asia Commercial Trust was constantly trading at a discount, especially after the social incident happened in Hong Kong. They have been trading slightly more than 10% below their NAV. But after the merger, the REITs by right supposed to trade at the NAV. But due to the current market condition, this REIT is actually trading more than 10% below the NAV. And this is year-to-date chart is included the dividend you collected. So if you include the dividend, actually the REIT is still down double-digit 14.37%, which is still way underperforming the SL, which is year-to-date is a flat. However, let's look at longer term. You have to invest in Mapletree Commercial Trust since their IPO at April 2011. From now, it's more than 11 years. You will make a capital gain of 80% over 11 years. It's not really that great. You just look at 80% over 11 years. But if you were to take in the dividend into considerations, actually you have made 232% returns. Would this REIT able to continue to grow in future? Let's look at some numbers. Let's look at VivoCity, which is a crown jewel for these REITs. They have a great impact to the future dividend growth of these REITs. And from here, we can see that the shopper traffic actually have increased from last year from 12.6 to 18.9. But however, compared to the pre-COVID level, it still got a big room to grow. And as we know that VivoCity is a place that not only Singaporeans go, it also a tourist will go there. And as we are opening up our economy, opening up traveling, we expect more tourists to come to Singapore, and we expect the shopper traffic for VivoCity will continue to improve. Let's look at their tenants here, and actually their tenants here actually have surpassed their pre-COVID level. With the tendency is surpassed the pre-COVID level and plus coupled with the shopper traffic will continue to increase, we are able to see that VivoCity were able to continue to generate even better revenue going forward. And that point to note, VivoCity are also going for AI called the Asset Enhancement Initiative, where they're going to reconfigure 80,000 square feet of their property around tanks. Then the opening will be progressive, expect to be from mid-2023. From there, we could able to see even a further uptick in their tenant sales from there. Let's look at Festival Walk. which contribute about 1/4 of their AUM for the REITs. The shopper traffic for Festival Walk is also quite a distance away from the pre-COVID or pre-social incident happened in FY1819. And also the tenancies have not recovered yet, unlike Vivo City. So with the reopening of border, we should expect Festival Walk worse to be behind them already. It should only become better going forward. One key change about the merger is there's a change in investment mandate where Mapletree Commercial Trust have renamed as called Mapletree Pan Asia Commercial Trust. From there, they are able to expand their properties out of Singapore and able to acquire property in the Pan Asia region where you see consider the China, Hong Kong, Japan, Korea region. But another key thing is the management fee structure have changed to a structure that have a more closer alignment of interest with the unit holders. The new fee structure will based on, the base fee will based on 10% distribution income, and the perform fee will be based on 25% year-on-year growth in DPU. The DPU collected this year must be higher than the DPU collected last year. Then the manager will have perform fees. If not, they will have no perform fees. This is really a better alignment of interest with unit holder, because as a unit holder, we want our DPU to grow every year. This is a chart to show the difference between the old fee structure and the new fee structure. The old fee structure is based on base fee, which is 0.25% of the asset, compared with a performance fee is based on net property income. So to achieve these two, I would say that the risk manager, what they need to do is just need to buy properties. As long as they buy property, the total asset value will go up. And as long as they buy property, the net property income usually will go up. And by just buying property, they were able to enjoy a higher base fee and they were able to collect performance fees. But with the new fee structure side, the base fee will based on distribution income. Also, this one, if they were to buy property, actually the distribution income by right should also go up. But the next part is the performance fees. If they want to have bonus, just like when you work for someone, we're looking at year-end bonus, we're looking at performance bonus. So the performance bonus will be tied to DPU. If your DPU never go up, they will not have performance fee. That means they work for the whole year, they got no performance bonus. From this table, we are able to see that the base fee actually have increased. Base fee have actually increased compared to the old structure, which is 43.6 million, compared to a range of 56 to 57 million. But we look at the performance fees. Based on the old structure, they will get 28.6 million of performance fee because it is based on purely on property income. But if we were to based on growth in DPU, they only have 2.8 to 6.4 million because we know that it's a tough year last year where the DPU growth, especially Mapletree North Asia Commercial Trust, was not performing, and thus our performance fee have dropped. And in fact, Mapletree North Asia Commercial Trust, the risk manager didn't get performance fees during the social incident period. So all in all, the management fee will be lesser, and total management fee as a part of total asset actually is about 0.35 to 0.36. It is considered on the low side. And with this new structure, it will actually push the risk manager to work even harder, as if they want to have performance fees, they have to sort of ensure that we as an investor, our DPU will grow year on year. This is a track record of the previous two REITs. So from here, we see that actually Mapletree Commercial Trust was all the while one of the best REITs in Singapore with more than 10 years track records, where their NAV have a CAGR of 5.8% per year. And you see when the REIT's NAV grow, the share price will also grow in the same direction. Now, coupled with that, DPU have been growing at 5.4%. This also resulted in a positive growth in share price. And this is why last time we showed you the chart that Mapletree North Commercial Trust able to deliver more than 200% returns since the IPO in 2011 to today. But when compared to the Mapletree North Asia Commercial Trust, the NAV is still positive at the 3.1%. It's still growing, but the DPU also growing at 1.7%. But compared to the old Mapletree Commercial Trust, it is still not as ideal. But we also need to factor in of the social unrest they have encountered in Hong Kong, which had affected Festival Walk. And at that point of time, that Festival Walk contribute more than 50% of that REIT's revenues and income. So nevertheless, it's still a pretty decent performance on that. So when these two REITs merge together, we should expect a positive return, and we hope that with a bigger mandate and bigger in size, they should able to perform even better going forward. This is what the strategy the risk manager have publicly disclosed, what they plan with the new merger entity. So from here, we can see that Singapore will still remain their core. So Singapore will still contribute more than at least 50% of the total revenues, or even income to the REITs itself. And Hong Kong, they got this festival, and I doubt that they're going to buy another property in Hong Kong where festival itself already contribute about 1/4 on that. And we know that festival is on a path to recovery. It should only get better. And for Korea, they have started to go into Korea currently with only one property. And when they start to get more and more property, then there will be more economy of size and economy of scale for them, which will be a good move. So for the Japan side, not everything is rosy for the REITs going forward. Is that currently we know that the yen have crashed against the US dollars, as the REITs actually have the intention to divest off some of the not so ideal, or we call the non-core asset of their Japan properties. But currently they are facing challenges of divesting the property at a good price due to the current market environment. This will actually delay the divestment of the properties. And similarly for China, we know that China is of the current zero COVID policy, and actually the economy is not doing that fantastic compared to the past, and the occupancy rate of the China property have been declining year on year. And they also have a challenge if they want to divest a China property. They also can't really divest it now, as it is not an ideal time to divest. So in a way that their plan may be delayed further until the economy get better. So with that conclusion, I personally feel that the REITs will be able to continue to grow, but however, inorganic growth will be tough in the current juncture, as due to the high gearing of more than 40%, and also due to the current interest rate environment and market condition, where it's very hard for them to find a yield accretive property for them to acquire. So the only way they can do is mainly doing on AI, for example, like VivoCity. But however, AI will take time, and we can only see the VivoCity AI result progressively from mid-2023 onwards. So with this in mind, we should not have a very high expectation of these REITs in the near term. However, due to a long-term track record, if you are a long-term investor, then maybe I believe that the REITs were able to weather through current market uncertainty and grow stronger in the future. That's all I have to share with you today. If you feel that this video have benefit you, do remember to like, share, and leave your comment below. And lastly, do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye-bye.